Hey everyone, welcome back to the channel. Today, you'll be learning how to apply one of the most powerful trading tools, the Fibonacci retracement tool. Sure, some of you may have heard of it, but in this video, we'll discuss a highly profitable method of trading with this indicator. We'll start with the application of Fibonacci to trading, then move on to advanced Fibonacci trading strategies, as well as some common mistakes that traders make while using this indicator. So there's a lot to learn and you won't want to miss this, so make sure you stick to the end. Before we discuss the trading strategies for today, let's talk a bit about the Fibonacci numbers themselves. The Fibonacci numbers are essentially a number series, starting from 1, in which subsequent numbers are created by adding the values of the previous numbers in the sequence. For example, 1 plus 1 equals 2, 1 plus 2 equals 3, and 2 plus 3 equals 5, and so on and so forth. These Fibonacci numbers were associated with some parts of our lives. For example, you can see it in the petals of flowers, the shapes of our faces, and also some Asian architecture that was found to be correlated with Fibonacci. So this led to some analysts believing that the prices of financial assets might correlate with Fibonacci. Every number in the Fibonacci sequence is 1.618 times the previous number. And that is also why the 1.618 is called the golden ratio. I've spoken about this multiple times on this channel because this is very significant in trading. But you will learn more about it later in this video. With that being said, let's start by discussing the applications of Fibonacci to trading. Based on your understanding of price movement, you should already know that the prices of most assets do not move in a single straight line. Instead, the price tends to move with impulses and retracements. The impulse is a price expansion or displacement in a specific direction. These are usually substantial impulsive moves that occur when the market is trending in a single direction. The retracement is a corrective move that occurs after the impulse. Now, as traders, we have to try to enter positions before the impulsive move occurs. That's where the big money is made. So that brings us to the question of how do you know that the retracement is over and the price is due for a new impulse? Well, we can use the Fibonacci retracement tool. Now, if you are in a bullish market, price will make impulsive moves to the upside. After the impulsive move, there is usually a retracement. You can use the Fibonacci retracement tool to determine whether the retracement is complete. That is, you are trying to predict where price could potentially find support. Similarly, when price is in a downtrend, there would be impulsive down movements, followed by retracements. In this scenario, the Fibonacci retracement tool helps determine resistance area where the downtrend could continue. Most charting platforms such as TradingView provide a lot of levels on the Fibonacci retracement tools. Now, you don't have to use all of these levels. Personally, I use the 38.2, 50 and 61.8 levels. You can remove the other levels from the Fibonacci tool. Now that you understand what the Fibonacci tool is, let's talk about how to apply this tool to your trading plan. The first thing you need to do is to identify the swing highs and lows. To apply the Fibonacci retracement effectively, you need to understand the market structure and correctly identify swing highs and swing lows. In a trending market environment, you need to identify the most recent major swing high and low. After this, you need to select and plot the Fibonacci retracement tool. In a bullish market trend, plot the Fibonacci tool from the major swing low to the major swing high. You have to plot from the low of the swing low to the high of the swing high. Make sure you plot the tool from the low to the high. This ensures that the Fibonacci levels are properly aligned and accurate. As you can see, the three lines are the Fibonacci retracement levels. They are the 38.2%, 50% and 61.8% of the entire impulse. In this example I've shown you, price found support at the 50% level. In a downtrend, we can use the Fibonacci retracement tool similarly. First, you need to identify the major swing high and low. Then draw the Fibonacci tool from the swing high to the swing low. Note that if the market is in a strong trend, it will respect the 38.2 level. In a strong trend, the buying or selling pressure prevents deep retracements. And that's why I love to use the 50% and 61.8% levels in most trends. But in very strong trends, I use the 38.2% level. Now that you understand how to apply the Fibonacci retracement, let's move on to the advanced Fibonacci trading strategy that I use. We will discuss this in 3 different steps. Step 1. Identify the market trend. Identifying the market trend is critical to the success of this strategy. While using the Fibonacci retracement, we aim to capitalize on a price expansion in the direction of the trend. This means that trades taken with the Fibonacci tool are pro-trend trades, so you have to determine the direction of the trend and trade in line with it. Step number 2. Identify the recent swing points. Swing points are swing highs and lows. You need to identify the swing points relevant to the time frame you are trading because they will help us plot the Fibonacci tool correctly. And step 3, look out for confluence. When the market trades to the Fibonacci level, I look for additional confluence to confirm that price is highly likely to move in my favored direction. There are lots of ways to confirm the direction of the market, but I will share 2 of the best confirmation techniques with you just to help you get the best out of this strategy. The first confirmation technique involves the use of moving averages. Moving averages are dynamic support and resistance tools. You can use different moving averages depending on the price trends. Like we discussed earlier, you have to trade in the direction of the trend. The next step is to mark the swing points, which are the swing lows and swing highs. With this marked out, we expect the market to find resistance at the 3 Fibonacci levels. However, it's challenging to determine which of these levels will act as a resistance as price retraces. And that's where the moving average comes in. When a moving average aligns with a Fibonacci level, there is a high chance that this will act as a resistance zone due to the confluence. This adds confirmation to our existing buyers. Using this confirmation strategy, you can place your stop loss at the Fibonacci above the entry and your target at the near-term low. So let's take a look at this buy trade here. Price gave an impulsive move upwards. After this move, a swing high was formed. The uptrend was confirmed because price was trading above the moving average and the upward slope of the moving average. So let me break down why I took the trade in this case. The first step I took was to identify the swing high and swing low. Then I plotted the Fibonacci from the swing low to the swing high. When price started to retrace, it found support at the 50% Fibonacci level, after which it continued to move upwards. As discussed, you cannot simply trade based on the Fibonacci retracement tool. That's why I use the moving average as confluence. I entered at the price point where the moving average coincided with the Fibonacci level. Since we are in an uptrend, we expect the moving average to provide support. Hence, As there's confluence with the retracement tool and the moving average, buyers came in and moved price upwards. I placed my stop loss at the next Fibonacci level, and this trade had a good risk to reward ratio. Now the second confirmation is using support and resistance. Support occurs when falling prices stop, change direction and begin to rise. Support is often viewed as a floor that is supporting or holding prices. Resistance is a price level where rising prices stop, change direction and begin to fall. Sellers come in at resistance levels and take the price lower. When a support level is broken, it becomes a resistance level. And of course, the opposite is also true. When a resistance level is broken, it becomes a support level. So that's the basic understanding. Let's apply this to the charts. Take a look at this impulse right here. After the impulse, price gave a corrective move to the downside and found support at the previous support level. This also aligned with the 61.8 Fibonacci level, which acts as a strong confluence for our trade. I placed a buy trade as price touched the retracement level and kept my stop loss below the next Fibonacci level, with my target at the most recent swing high. Mind you, you don't need both confirmations before entering a trade. You can trade with either of them. But if you have both confirmations on the same setup, then it's a high probability setup. In this case, if we add in the 50 period moving average, we will see that the moving average is acting as dynamic support as well. This is an A+ setup which I would be very confident in taking. Now, what I love most about this strategy is its simplicity. You can easily spot this setup on the charts and execute trades that have a good risk to reward ratio. The common mistake traders make while using the Fibonacci tool is the lack of confluence. Always wait for confirmation before executing your trades. So go ahead and spend some time to backtest this, because the more you do it, the better you understand this setup and the easier it is to spot it in live market conditions. So that's it for today. Thank you very much for watching. Do hit the like button and subscribe if you haven't already done so. If you have any questions, kindly drop them in the comment section down below, and I'll see you in the next video.